So my name is Vaibhav. I live in LA, Los Angeles, and I'm a real estate investor. And I, along with my partners that are there, Gohar and Hemal, uh, we we invest in multifamilies and we do syndications. And with me, we have a guest today, which is Adarsh, or he goes by Adi, and he is an expert in different kind of investment, which is the stocks. So, so we're going to take his perspective on things because most people will be interested in stocks and how they'll do in the current situation and all of that. So we'll get Adi. Did I miss anything about you? Do you want to just introduce yourself quickly?
Yeah, sure. My name is Adi Shyamsundar. I'm based out of El Dorado Hills, which is north of Sacramento, so also in California. Like Hemal said, I'm on a different spectrum of investments in the sense that I'm a financial advisor, so I'm fiduciary, which means I manage wealth and money for people based on their objectives. I also have a hedge fund, which is called Rachela Investment Fund, LP. The name of the parent company is called Polaris Capital Management. And that's pretty much it.
All right, that's great. Thank you, Adi. And again, Gohar and Hemal are here. Those are my partners. So I'm going to start with the topic. So before we go ahead and discuss what impact it will have on economy and other things, let's just get the lay of the land, meaning what exactly is happening right now and what are the impacts on the economy that are very clear to us that'll happen. So one, of course, everybody knows what's going on. There's a war going on between Israel and US and Iran, essentially. And in that war, there's active fighting going on. I mean, not a combat, man-to-man combat, but there's missiles being, used. And the main thing that's really a problem for the entire world is the Strait of Hormuz, where 20% of the world's oil supply moves. It's been closed. And as a result of that 20% supply getting out, the oil prices have increased a bit significantly, actually. Like the oil used to be $75 per barrel, and now it's about 120 and inching towards 150. In Asia, is already getting sold at 160 because they can't get it from anywhere else cheaper. And about 20% of world's LNG capacity, which was in Qatar, has been taken off because of these attacks. So that is gone. And another interesting thing, what people might not be aware of, is as a result of that, the allied industries are also going to suffer, like fertilizers and helium production and all that stuff. So Qatari helium is get used widely, and that, again, helium gets used in a lot of industries, including semiconductor industries, and Adi can tell you more about that. And so those industries are going to suffer as well. So if you can't get helium on time, you can't produce chips. So anything else, Adi, you want to add to all of this?
So I think you covered the main things. And like you said, the fertilizer is the one that surprises people. A big chunk of the fertilizer supply, especially in Asia, comes from both Israel and the Middle East. Right? It's almost 40 to 50% of the fertilizer comes from there. And apart from that, you have Canadian companies. So the sources are not too many out there.
Right. And one of the important point to note here is that a lot of people think that the US produces more oil than it required. Then why does the gas prices go up in the US? And that's simply because, and Adi, please correct me if I'm wrong, right? It's simply because the price of oil goes up world over. And there are Asian countries who are trying to procure oil from United States as well. So now the producers in the United States have a choice of selling internally versus externally, and so they have to pay, the internal people also have to pay the market price. And as a result of that, oil price goes up. It doesn't matter whether, so here there are no price controls in the United States, which are, they don't say that, oh, you can't sell it outside unless you fulfill the internal demand or anything, right? So as a result of that, you just pay the market price, and hence the prices go up in here also. And so Adi, if you want to just begin with like just what could be the impact of oil prices on the general economy, and then maybe you can get into like what could happen to stocks or industries or stuff like that.
Right. And just to add to your point on oil, right? So at any given point, it's similar to producing something, right? So the Exxons and Chevrons of the world cannot just produce more oil overnight, because they've planned for X amount. You have to do things with the well and put it out. So, and there is like backwardation and there is future contracts. So the way you think of the stock market versus the way the commodities work are very different. And there are multiple markets. So the prices are different in Dubai and Oman crude versus what you see in the US. So it's a lot more complicated than most people would think, that oil is oil and it should be similarly priced. And with spot prices, a lot of challenges can occur. So you're spot on there. And again, a lot of people assume that fossil fuels are bad. We all should move towards green, whether it's nuclear, solar, and so on. But pretty much everything that is a starting point requires some form of oil or coal in production, right? There is a lot of things that oil and gas go into various forms for any sort of production. So it's surprising to people, but there's a very good book called How the World Works by a guy called Vaclav Smil, and it talks about all the good stuff and how it's really hard to get off of fossil fuels for a long time, even though the progress towards green energy is meaningful. Hence everything goes up, because whether it's your food, whether it's producing a car, producing semiconductors, pretty much anything you can think of will go up in its value in terms of pricing, right? Not what it can give you, which is essentially inflation, right? So higher oil has always led to higher inflation, because it's a key ingredient into everything that's manufactured out there.
Yeah, and travel as well, right? I mean, jet fuel is a problem right now in multiple countries. And as a result of that, the airline prices are going to... today I was watching Fareed Zakaria show, and he was mentioning that the United CEO is planning for $175 oil a barrel, because that's where they expect it to go pretty soon. There is one important point I want to make also, is that even though President Trump is saying that he's extended the deadline to April 6th, this is like today's news.
Right.
The reality is that the Strait of Hormuz is going to be closed until a deal is reached somewhere. So that means the oil supply will be squeezed until this conflict gets ultimately solved. The peace in between doesn't matter, because
Right.
Iran is not willing to they're not willing to just let the ships go through that. And another problem is that, let's say if Iran tomorrow says that I will let ships pass because they're my friendly countries or something, insurance companies won't insure those ships until the conflict is over. And because of that, the ships won't be able to pass, because if there's no insurance, the ship is not moving. So these are some of the real life challenges that are being faced there. So this temporary truce or peace, whatever they have, it's actually not very useful. It doesn't do anything for oil markets that much.
Yeah, if I may add, Vaibhav, the other thing people miss out is like a lot of things are stranded in the strait at this point, right? So it's not like open and you get back to regular traffic. Even if you say it's open and they're not going to harm the ships, it's going to take like maybe a couple of months just to normalize
Everything. Yeah, makes sense.
And the Qatar LNG facility, I think their administration is saying it's going to take them anywhere between 3 and 5 years to build it back. So LNG and hence LPG, which is a big part of Asia, I think is in a little more of a crunch.
Yeah, it's going to be a big problem with that. So if inflation goes up, right, I think the biggest thing that gets affected is interest rates, right? So do you have a take, Adi, on interest rates and what will happen to interest rates? And I know Fed has said that they will, the like few weeks ago when there was a meeting, the Fed chairman said that there'll be only one cut likely this year. And that was considered as a bad news. But what do you think, Adi, will happen?
Yeah, no, it's a great question, right? So I'll speak in general about the Federal Reserve banks across the globe. So US is unique in the sense that it has a dual mandate. The US Federal Reserve has to monitor both employment as well as inflation, right?
Inflation.
Whereas the rest, for example, the European Union, they just care about inflation, right? So most likely, the European Union will raise rates, right? In the US, the Fed is monitoring it. A lot of the market commentators, the macro commentators are saying if inflation goes up, the Fed will likely have to raise rates. Now, of course, anything can happen. They can choose to do whatever they want, and for every action there is a repercussion, right? If they cut rates when inflation is high, then there's going to be some sort of challenges, right? Which is not a good situation. And if the dollar weakens, then inflation also increases because most commodities are priced in dollar, right? So if the dollar stops dropping, then the commodities, there'll be more demand for it because everybody else can buy more. So that's the repercussion. And there is a checks and balances there, but it's likely that if inflation goes up, most likely the Fed will raise rates. But again, we cannot predict this thing, but that'll be the logical step if inflation goes up.
Okay. At this point, right, before we go further, I wanted to see if anybody wants to participate or anybody wants to say something that they want to say. I mean, you can just unmute yourself and say it, or even put it in the chat window. It's a discussion. It doesn't have to stay with just two of us. So please, interrupt us, or let us know if you have anything that you have observed. Look, we are no way expert in geopolitics or anything, right? We are also going on a news that we hear. We have our own analysis that we understand, that we interpret things in a particular way. But besides that, I think please feel free to speak or tell us about what you think about these things. It'll be great if it can be a two-way conversation. Yeah. And Hemal and Gohar, please, I mean, if you want to say something, just go ahead and let us know. What do you think? So if nobody has anything, then I have my next point, which is now that I want to understand how interest rate affects various industries. I can talk about real estate a little bit later, but Adi, if you want to just talk about how would interest rate affect all these companies, right, that are listed on stock market?
Yeah, usually, the companies in the US will tend to pass on the higher prices to the consumers as much as they can, right? So stocks are typically a reasonable hedge in historical terms for inflation, right? So industry-wise, I think industries that are a longer duration, like for tech, for example, startups, right? That ecosystem depends on loans and so on. They prefer a lower rate, right? It's not like it's the tech world is going to take a big hit, but there will be some repricing on smaller caps and smaller tech companies, right? And tech in general, because they see it as long term. And interest rate goes up, people will have an option in being able to go to treasuries, right? So that's an option. Utilities are a toss-up because people buy utilities for dividend, and um, you know, it could be that people sell some utilities if your treasury yields are more. But in general, companies will pass along inflation costs, right? And again, there's a difference between, okay, if we have higher inflation, the yield stays the same in the sense the Fed does not raise rates, but the inflation's higher and the Fed raises rates, right? So there is a distinction in those two situations. If the Fed raises rates, then obviously the interest loans, it impacts everybody, right? So car industries can, not do so well, right? But if they don't raise the interest rates, then it is possible that people will go to utilities, because now utilities are still giving more dividend yield, even though there's inflation. They will go to dividend yielding stocks and safer stocks, because the treasuries are low, but other stocks are giving a higher dividends, right? This is what happened in the past year when the Fed started cutting rates. If you see companies like Coca-Cola, right, or utilities or dividend-paying stocks, they've done reasonably well. Tech is not. Tech is in a great spot. So I think AI and the related ecosystem will do well. Oil has done well, but there will be sensitive areas like banks. If interest rates go down, banks will not do well, right? So it depends on the industry, but overall, stocks have generally done well in higher inflation. But I don't want to miss the point that if the interest rates go up, then it can have repercussions on the broader economy and can slow down the economy in some sense.
So can we elaborate that a little bit more? Like, how does interest rate going up slows down economy? Like one of the, and I could attempt to do that, and please correct me if I'm wrong, which is,
Please, yeah.
I think a lot of companies require capital, and
right.
they generally, there's two simple ways to get capital, right? One is equities and one is loans or debt. And now what happens, the cost of debt goes high, right, when interest rate goes up. And that means whatever projects they were going to finance using debt becomes costlier, and their ROI might not pan out.
Right.
And in that case, they might either postpone the projects, or they might not do the projects. And if they're not doing projects, then they might not hire more people. And then if they don't hire more people, then that means there are people jobless, and it just trickles down everywhere. Did I do it good job, Adi, or what do you think?
Yeah, no, absolutely. And if I may add, right, the interest rate that the Fed sets impacts a lot of things, right, including loans, right, which means even your real estate loans will go up, right, in terms of interest. And people who are probably being able to afford a home today because Fed has cut rates, if they raise it by another %, then they will go out of the market, right?
Right, exactly.
A lot
mortgage payment will be too high, right? Exactly.
Yeah, mortgage payment will be too high. Credit card interest rates go up. I mean, unlike many people who pay their bill monthly, there's a good chunk of people who don't pay their bills monthly, right? Meaning the full portion, and their interest rate goes up. But it's also that even for companies, they are on a rolling basis, right? So they will have taken a loan that matures in 3 years. Usually they refinance. They don't pay it off. They just keep rolling it. And now we borrowed at 3. Now suddenly it goes up to 5 on the same loan or a similar loan amount. So yeah, it just raises the cost for everything. And I don't know who said this, but interest rates act as a gravity for assets, right? The higher the interest rate, they tend to pull down assets. That's the
so
assets.
In general, in real estate industry, what happens is the higher the interest rates, the less is the value. That means the prices are less, right? So that means if you're planning to sell, it's not a good time. But if you're planning to buy, it's a good time, because you can get it at a high interest rate, low value, and then later on when interest rate go down, you can actually sell it at a higher value and then cash in. So that's one way those who believe in timing the market can do. But in general, what happens is banks look at, when they issue a commercial loan to a property, they look at debt service coverage ratio. And what that means is that they look at how much mortgage payment can this property afford. And if the interest rates are high, then that goes down. As a result, their loan percentage goes down, or LTV, or loan to value ratio goes down. And if that goes down, that means properties are simply getting less loan. And if you get less loan for a property, I mean less percentage or less LTV, then the investor return goes down. So it's actually affects, and there is one big effect happened with a lot of bigger multifamilies that were acquired around 2020 to 2022 at about 3% rate. Some of these bigger multifamilies are three-year fixed arms, and commercial loans are always arms. There is no concept of 30-year fixed in commercial loans. So in that case, those loans got reset in 2024 and 5. And at that time, the rates were 6%. And some of these properties went bankrupt because they could not afford the payment.
Right.
The payment doubled, essentially, right, for these properties. So there was a lot of problems with the properties that were bought in really, really low interest rate. One of our properties bought at a low interest rate. It was like 3.7 or something, but we have a 7-year arm in it. So, and it was bought in 2023. So we have a long leeway. We have time until it was 2029 or 2030. So I think we are going to be okay. Our payment won't increase. The rest of our properties are higher at 5.7 or 5.9 or something, or even 6.05. So we are going to be okay because we have 5 years to go. And by that time, the interest rates will probably come down. But it's a big problem if you are in a market for selling, because higher interest rates mean you will get less value. It's almost guaranteed.
Right. Yeah, no, I think that's a good point. And it's similar to stocks, right? So if you're buying good stocks, including the S&P 500 or quality stocks, because if the interest rates are high, that means when eventually the interest rates go down, you bought it at a price which is not reflecting that thing, right? In stock calculations, the interest rate goes in the denominator, so it's just math in some sense, right? So as the interest rate goes down, the value of assets tend to go up. And to your point, I think there's a slide that Puranik can share in the sense, the question of what happens, post some geopolitical issue, right? And obviously the S&P 500. There's multiple cases where, on an average, a year out after a crisis, they've been up 14.2%, right? Of course, there have been a couple of situations where it hasn't worked out. One is COVID and one is 9/11. But
do you want to share that slide, or do you want to show the graph?
Yeah, let me share that, I guess.
Go ahead, yeah. Share it. I've seen that graphic, and it's very interesting for people to see.
Yeah, I'm going to see this.
Sure.
Okay, is it up?
Go ahead, we can see it. Okay. We can see like a title of the thing.
Yeah, no worries. I have to get the disclaimer that it's
sure, yeah,
not financial advice. But yeah, so this is an interesting chart, right? And it goes all the way back to the 50s and 60s, the Korean War, the Cuban Missile Crisis, the 6-Day War, Gulf War, and so on and so forth. And again, if you look out 1 year after, right, what was the S&P 500's return a year out from there, right? And on an average, it's 14.2, because obviously, I don't want to say it's always positive. There are a couple of situations. And what I was pointing out to is this is kind of a double whammy, because we were just coming out of the dot-com bubble. We're not even coming out. We were sort of in the residual effects of dot-com, and you had the 9/11 effects, right?
Yeah.
So I think it just hit the economy quite hard, right? And Ukraine invasion was sort of unexpected, and a lot of commodities come from that region, and that's kind of reflective in this. The US put sanctions on movement of Russian money, and then Fed raised rates too, because inflation was at 9%, right? So that's my point of, if Fed raises rates, your asset values will go down. But the data supports the case of buying assets during geopolitical shocks.
Right, and that's also because I guess Warren Buffett once says that when the rest of the world is fearful, then be greedy, and
Absolutely.
be fearful when the rest of the world is greedy.
Absolutely.
That means when the things are going up, everything is going up. That's not the time you enter the market. And things are going down, there's uncertainty. Then that's when you enter, because if you enter that, then you're going to come out good. Because you're going to enter at a bad time essentially and come out sell at good times. Yeah. There is one. So Himo, I hope I'm addressing your question. Right, we are addressing that how Fed rates going up is affecting interest rates. There is another interesting thing which happens when these kind of events happen, and that is uncertainty. Uh, and what businesses like is businesses want certainty, and they want to plan out a year, 2 year, 3 years down the lane. And when these kind of events happen, and there's a lot of uncertainty, right? Like, well, I don't know if the war is going to end tomorrow, or it could end 1 month later, it could happen 1 year later. Like we don't know, we have no idea. So what happens in this case is businesses, whatever capital expenditure or whatever big decisions, big projects they're going to take, they postpone these projects. And as a result of that, they're in this limbo, and so they don't spend money. They stop spending money. And when that happens, then it affects, it creates a problem, because if they're not spending money, then somebody's not getting that money, right? Either they're not hiring employees, or if they're not hiring the services from the vendors, right? Those people are not getting money. And that actually is a problem. And if that's how sort of the growth reduces overall. So the uncertainty period is also important. If it's a short period of uncertainty, it might not have that much big effect. But if it's a long period of uncertainty, then it's a big problem. Like the slowing down growth is one thing, and then contracting is a next step, which we call recession, right? So if it prolongs to a lot of time, then it could go into contraction as well. Anything, Adi, you want to say about this?
No, on the manufacturing side, I mean, it's exactly right. In projects, I mean, people are willing to take the sunk cost, right? Let's say you started a factory, and then something really bad happens. They put in 50,000. They'll just leave that, because that's better than putting, good money after bad money, right? So that's exactly right. People will stop, and they'll just wait. And when things change, they will get back into the projects. So there will be a delay, either due to slowdown, and in some sense it's circular, right? Fed raises interest rates, things slow down, and it kind of can create a cycle. Just like when the rate cuts happen, it creates another cycle.
Yeah, that's great. We also have a question for Anirban, which is, he's saying, what is your contingency for 5-year mark if inflation remains high with high interest rates? Do you sell regardless of, or hold property till a threshold? So my simple answer is that you have a choice at that point. So you run the math and you see how much cap rates have moved, or how much are you getting the price that you wanted in your original projections or not. If you're not getting that price, then simply wait, right? A year or two, since the property produces cash flow anyways, so there's no harm in waiting, right? So at that time you run the math, and I think we just take a call at that point whether to sell. But the beauty about the real estate, or even holding any asset, is that the selling point is not decided, right? Meaning, even though we have a hunch that, okay, we'll sell in 5-7, not hunch, but a projection that we'll sell in 5-7 years, you don't have to sell it. You can simply wait for 1 or 2 years, and then that'll correct the problem. And since the property is producing cash flow, it's not like you're not getting anything. You will get cash flow for those years. So to answer your question, Anirban, yeah, you can keep holding. You can run the math at that point, and if not, just hold for a couple of years more. There is a
I think the math thing might that makes sense, because one concern was, like, if the rates go up, since this is a commercial property, you are not at a fixed rate, so you will end up shelling out more towards your mortgage in that event.
Yeah. So you're right. I see. So your question was more like, what happens if it becomes unaffordable. So it really depends. I mean, by that time, your net operating income has also increased, right?
Right.
So you just have to see whether is it going to become a problem for you to pay a mortgage or not. Now, that's where actually low leverage comes into play. So what happens is in the risky assets, right, like risky real estate assets, they try to maximize loan. That means you get 70% loan in commercial loans, that 70, 75% even sometimes. In that case, it is harder because the loan is big and the mortgage payment is also going to be big, and the increase in the mortgage payment is going to be big. But let's say if you have a less loan, say 60% only, 65% only, then in that case, your loan is, because your LTV is less, your loan is less, then your increase will also be less, right? So it really depends on what the person that you're dealing with, the real estate investor, sponsor, or syndicate that you're dealing with. It depends on how conservative they are, what is their loan to value ratio, what is the risk profile that they have generally, right? So it all depends on that, right? So if their loan is less, then their increase might not be that much. Does that make sense, Anirban?
Thanks
Yeah.
for the explanation. Yeah, that makes
Yeah.
perfect sense. Thank you.
Right. Now, there was another question we have. Adi, if you want, you can just take it. What, in your opinion, would be considered long-term uncertainty? Do you want to take that, Adi? Hemo is asking that.
Okay. So can I ask a follow-up? In sense, when you say long-term uncertainty, are you asking if this conflict continues for a long time, or
Yes.
Okay. So
I mean, thank you guys for doing this, and I just wanted to kind of get a sense of, what would you guys consider short term and what, in your opinion, is long term, because I think that has quite an impact on how everything works, right? So getting an idea about that time frame would be great.
Sure. And you're referring to the conflict, right? That's what you said.
I mean, I think I'm just, trying to piece together your thought about the Fed's not reducing the interest rate or maybe even increasing that coupled with the idea that we have the war and the uncertainty that's going on right now. If this continues for a longer duration, then obviously the Feds may not cut the rates, but then that will also have a compounding effect on everything else. So I would love to know what the two of you think about it.
Yeah, no, great question, Hemant. Thanks for clarifying. And Vaibhav, if you don't mind, maybe this is like what to do kind of a question. I don't know if you want me to bring.
Can I just answer? Like I will give you my opinion about this, and then you can do what to do in these cases as well. Sure. So, in my opinion, like a month from now would be a short term if it continues. But if it goes on for like a year or so, then it is really long term, and it's going to do real damage in some sense, right? I think the interest rate could increase in that case, not just like if the oil goes to $200 a barrel, there will be damage for sure. Inflation will be too much. It might take a while for inflation to come back, and Fed will have to raise interest rates so much to actually slow it down economy, and which could result into even a I'm also scared to say that word as a recession, but it could result into that. So I think I'm really hoping that all of this stuff gets over in like a month or so. But if it stays longer than that, and in other countries, it's going to be even way worse. Like countries like India, and they're going to suffer way, way worse. So I think that's what I would say. And Adi will go to like what to do in certain situations. So give me a minute, because there's another question from Gohar where, Adi, do you have any thoughts on how the international markets will do during these times? So if you want to talk about international markets.
Yeah, no, absolutely right. Because so I mean, this is where we have to think about it a little in terms of the geography and geopolitics, right? In some sense, we are blessed to be in the US in geographic terms, because you have ocean on both sides. You have Canada on the north and Mexico on the south, like loosely speaking, right? US is energy sufficient. at least for a decent amount of time. We can get uranium from Canada if we want, and so on and so forth. So it's a good spot to be in compared to most of the world, other than the Middle East itself, right? Because Europe, they've, the past years, they're not running as many nuclear plants as they could, as well as they've always dependent on energy for their energy from other places, right? So so Europe is in not that great of a shape, right? Similarly, a country like Japan, which almost has no natural resources, imports a lot of it, is challenged, right? Majority of Asia is in a similar situation, whether you take Singapore. India is somewhere in between. India does some things, India gets some things, but India also has the benefit of having close ties with Russia, right? Now, the big juggernauts, China and Russia, which we'll call it as Asia, right? They will be fine because China has plenty coal, and Iranian oil will still flow through the Hormuz to get to China and so on. So, the problem points I see in my humble judgment is Europe, and then Far East Asia, right? India a little bit, and everything to the east of that, right, is going to be challenged.
Japan, Korea, all that stuff. Yeah, Singapore.
Korea, Japan are under. They're already under stress, right? So yeah.
Right. Okay. So then let's go back to your question or your point that you were about to mention. So if all of these things happen, right, or starts happening, then what should we do? Is there a playbook there? Or
Yeah, no, exactly, right. And to your point, if this goes on for like 6 months, I mean, it's going to be a challenging situation with things slowing down, right? And again, a lot of things can happen in geopolitics. What will Russia do? What will China do, right? Russia has enough oil, it can start doing things. I'll not get into that, but I'll just share this generic slide that, I can tell, in a broader sense, right? Because it's the question that everybody asks when something happens, right? So, I mean, this is, again, don't take this as complete financial advice. Please consult the respective people that you need to. The one thing you don't want to do is avoid knee-jerk reaction, right? You don't want to sell and start moving away and doing things for the financial plans you have in place. Your investment should always reflect your risk profile, right? Meaning, what is your time horizon, right? If you have a 5 to 7 year time horizon, yes, you can be in real estate, you can make a lot of money, right? But if you are in a 1 year time frame, it's going to be harder in some places, right? And it depends on your social factors, your employment situation, and so on, right? So again, the people, clients ask me, oh, do we need to be in oil? Do we need to be in gold? We were buying gold for our clients like 2 years ago, right? Again, it's just one of those things that you can't look for insurance when your roof is leaking, right? It's that kind of a situation. So you always want to have a smart plan for diversified assets, and you want to keep investing because the worst thing that can happen is the dollar or the rupee or whatever currency you have, inflation is going to eat into it, right? So if you're in a position to invest, like I said, based on your time horizon, your social factors, employment, investing is a great thing to do with various assets, right? And market dislocations create opportunities. So, markets overreact, they shoot first, and as later they'll sell the best stock. That's an opportunity. So we can only, prepare, and that's the fiduciary role that I do. And diversification is only free lunch. So long answer, at this point, if you're not in, for example, assets that are catered to inflation, right? Hard assets, commodities, and so on and so forth. That's a good spot to get into, right? Because it's like I said, you don't want to go get insurance when the roof is leaking, right? So that's kind of the answer. And I mean, I hate to see this because people are very comfortable seeing the money in the bank, but if it's an inflationary situation, right? And unless your interest rates are at 8-9%, then your treasuries are giving you 8-9%. But if your inflation is high, like it went to 9% in 2022, and your interest rates are only 2%, right? That's a big gap. So you want to understand that, and that's why you always want to be invested and know what you invested in.
Yeah, that's a good suggestion. And I'll also say something from real estate perspective, right? I really think that this is a buying time because it's not a selling time for sure. I usually do not recommend people to time the market at all. And I think if you have held an asset for a longer time, then it always comes out okay. It's just enough because generally an economic cycle turns around in like, I don't know, 5 to 7 years. And even in 2008, when there was a mayhem going on in the markets, about 2012, 13, the asset prices were significantly up, 12, 13ish, I would say. We were significantly up again, and things were running absolutely fine. So 4 or 5 years, things turned around, right? Also, it's interesting that Adi and I was chatting before, and he brought out an interesting point that all of this has happened in the past, and we have seen these things, especially people like us who have been watching investing since 2000 or early 2000s, right? For them, we have seen major black swan events, and those events that Adi was showing, right? The 2008 recession that we have seen. We have seen the dot-com bust of 2001, on the 9/11 2001. We have seen like COVID-19. We have seen Ukrainian invasion, and Adi, I think there were other events you were mentioning, right? That have happened. So we've seen all of these things, and I still remember exactly. I remember actually what I was doing in 2008, and I was in 2008. I was investing in a big way, and I had this account in Fidelity, where around that time I invested somewhere about 10 to 15, and eventually I took it to $20,000. And today that account has $170,000.
Exactly.
So it's 16, 17 years, but it's insane that how many times it has grown.
Right.
It's almost like, so the return there is just phenomenal. And I'm not talking about real estate. I'm talking about just some stock that I had bought it. I just didn't do anything for 16 years with that stock, right? So if you hold an asset for long enough, right, then you will always come out on top, no matter what time you have entered in. But in general, it's really a good time to enter in when things are really falling apart, I would say. Yeah, so there's no need to, if you panic and you sell, then you made a huge mistake, I would say. And that's why even we are also looking at, right, buying real estate right now. Just because, and I'm going to buy personal real estate as well, not just like the commercial real estate that we buy through syndications, all that. Just because we believe that this is time. It'll be expensive for a year or two, the mortgage payment, but then it'll go down. And by the time I want to sell, like next 5 to 7 years, it'll be absolutely okay.
Exactly. And that's a great point, right? I mean, and again, I'm assuming, Vaibhav, that your risk profile is like, I'm going to invest. I'm okay with it, right? And that's why, we have clients who are like, no, we know we need X amount of money for something, right? Whether it's sending kids off to school or whatever it is, right? So that's why your point of time horizon matters a lot, right?
Oh, I see. Okay. Yeah.
Yeah. So exactly to your point, you were okay saying, okay, I don't need this money for 10 years, right? That's a great situation to invest in. And this is not, again, financial advice, but I was in 2008, I call myself the first class of YOLO, right? You only live once, right? I was reasonably confident that, my job is going to be okay. And, I was in a good tech industry in semiconductors, and I basically invested everything I had in the stocks, and that was my thing, right? I was ready by that time. So, but again, my time horizon was like 10, 20 years up, right? I knew that there is very few situations where you've held stocks for 10 years or 20 years and they've not gone up in that time frame. Very, very few occasions, right? So the odds were very much in my favor.
Right, I agree with you. I mean, if you need money for something else, then don't invest right now, because you might not be able to get it back in a year. That's what
Right.
essentially you're saying. If you
Right.
need it for your college education or of
Right.
kids or whatever else that you need, then
Yeah.
don't put that money in the market.
Right.
If
Yeah,
you don't need it for next 5-7 years, then you're absolutely better off doing it.
Right. And anecdotally, in my business, a lot of times when the market is hot, people assume that, they can put in 100,000 in a year, it's going to be 200,000. We typically don't take that money, right? Because we tell them in a year, nobody knows what's going to happen. Even in the real estate, we hold for 5 to 7 years, right? That's when it pays off, right? If you need that money in a year, it's okay. Don't try to mess with it if you're sending your kids to school.
Yeah. So in that case, money market would be the just best way, because the interest rates are higher. So
Right.
you're going to get 3, 4, 5% in just money market. So put your money in money market, right?
That's right. Yeah.
Right. So for short horizon, put your money in money market. If you have a long-term horizon, then it's an ideal time to invest. That's what I would say.
Absolutely. It's a great time. If you have 10, 20 years of horizon, or even 5 years of horizon, I think it's a great time to put money into assets when there's dislocations like, these kind of situations.
Right. That's great. Does anyone have any other questions or that you want to ask, or any other interesting topic? I mean, allied to that, did we miss anything? Hope our explanations made sense to you and were logical. Anything anyone want to ask? Adi, is there anything else that you want to cover?
No, I think those are the main things. It's if your time horizon is great, then you have the capacity. Great time to invest in assets.
Right. All right. That's great. That's perfect. I just want to give a quick plug-in for both of our companies. If you want to learn about what we do, please go to oldmoneycapital.com, oldmoneycapital.com, and we do multifamily syndications. You can check it out, what we do, and if you want to request a call button there and then talk to us, we'll be there to talk to us. Any one of us, Gohar, myself, Hemal, we can talk to you. And Adi, if you want to just speak about your Polaris Capital Management.
Yeah, absolutely. So my website is going to be polariscapitalmanagement.net. Let me try to type that in there. And again, it's a similar thing. We have a call button there if our services are listed, and the fees are also listed, and so on. As a fiduciary, you can find me in SEC and so on and so forth. So you can go there, and our first hour of consultation is free. If you are, if it sounds interesting, feel free to contact us, and that's the website.
All right, that's perfect. Thank you, Adi, for
Absolutely.
sharing your insights, and hopefully this session was helpful to everyone.
Yeah, thanks.
This was very helpful. Thanks, guys.
All right,
Yeah,
cool.
thanks, Vaibhav, for inviting me. I had a great time. Thank you.
All right. Okay. Thank you. Have a good night, everybody.
Thanks, everyone.
Bye.
Bye.
Thanks.